Facebook, or Meta, is down more than 50% in the last year. They just got another downgrade from Wall Street, and I'm finally coming around on the stock, and I think it might be a good buy. I'm going to tell you exactly why and give you my low, medium, and high targets to where I'm interested in buying shares that you can then go and do your own research. All right, here we go. Here's the news of the day. Meta slips as Needham downgrades over deteriorating fundamentals and structural risks. Analyst Laura Martin lowered her rating to underperform from hold, noting that Meta is investing heavily in the metaverse while dealing with slower revenue growth. We lower our estimates because we believe cost growth will far exceed revenue growth for the next 2 years. Got it. That's all we really need to know about that. Now, I'm going to get into exactly why I'm actually getting bullish on Facebook, and it has to do, or Meta, it has to do with everything that's going on in crypto, has to do with everything that's going on in advertising, even a potential recession and deteriorating economic information. Most important thing to me is transparency. This is the $10K to $1 million portfolio I'm building, doing this over the next 10 years, adding $3,000 a month and sharing every step of the way. We have put in $72,500. We are currently at $64,741. That means we're down $7,700. Today alone, we were down $2,250, so not a good day for us. Here are the stocks I own in the portfolio. Full disclosure, I do not own Meta. All right, so let's take a look. If you've watched videos before, you know I love using fast graphs. I'm a paying subscriber. This is not an advertisement. I get nothing from them. This just shows the stock. It was up to 378 at a PE of 29 in September. And now it's down to 170. It's even lower because this doesn't show today at a PE of 13.5. If you look back, it's hard to find a time that Facebook ever traded at a PE of 13.5. So that either means awesome opportunity or broken company, falling knife, and that's what we have to decide. First, I like to see if a company has beat the market, and even with this drop over the last 10 years, Facebook has still beaten the market. I just found this new tool today. They've got a YouTube channel, Everything Money, and these guys are good. I like their software, and I just signed up for their software today. Again, not an advertisement, get nothing from them. But this is probably one of the most complete platforms I've found for stock analysis in one place. You still have to do your own research. You still have to have the fundamental knowledge of how to do this stuff and what you're looking for. And I think there's parts of this tool that might lead you away from growth stocks, which is what I invest in. But it's a great tool and it can just give us good ranges. And so I just love to share tools that I'm a paying user of that I think might be helpful for stock research. So a couple big things here that I love they just highlight. The market cap, 440 billion. Revenue, trailing 12 months, 120 billion. Net income, 37 billion. Trailing 12 months PE, we talked about this, 11.8. Their 5-year PE is 17, so that's much better than that 30-year that PE of 30 over its lifetime. So that's a better range right there. Profit margin, 31%, and 5-year profit margin, 33%. So we could tell 5 years been great, and it's come down a little bit because they're spending more on the business. Gross profit, 80%. 5-year average free cash flow, 24, and then in the last 12 months it was 39 billion. Great numbers. Then we see it traded up to that 384, 52-week low was 154, and we're at 162 right now after the day. So let's just take a look at 3 things on the income statement: how their revenue has grown, how their gross profit has grown, and how their net income has grown over time, really over the last 9-10 years. So in 2013, they had $4.65 billion in revenue. For the past year, they had $120 billion in revenue. That's incredible revenue growth. And that's why I love finding companies early that are hopefully close to this stage that Facebook was at and will grow into something potentially like Facebook in the future, or it doesn't even have to grow to be what Facebook is to still do great if you pay the right price. Gross profit from 4 billion to 96 billion. And then net income from 67 million to 37 billion. Another thing to notice with Facebook is that they have actually been buying back shares, which is kind of bad timing because of the drop in the stock price, but still it's good to see them buying back shares rather than issuing shares. And that's part of the thesis going forward for Facebook, is it's almost turning into, I mean, there's growth ahead, but it's also turning into a capital allocation play. Okay, so a couple things here. We love the large cash position, 7 billion. And then their long-term liabilities are 20 billion. And then if we look at free cash flow, 39 billion in the last year, almost 40 billion. And then the 5-year average has been 24 billion. So extremely strong. That free cash flow covers their debt. And this is what I like about this tool. They've got these things called 8 pillars, which is their own thing. So this is, again, everything money, not me coming up with this, but I like the way they do this. They're looking for the 5-year PE ratio. That's the share price divided by the average earnings from the last 5 years to be under 22.5. It's at 17.2. 5-year return on invested capital, they want it over 9%. This is 16.3. Revenue growth 5 years, 75.8 billion. So positive revenue growth. Net income growth, positive growth. Shares outstanding are down 6%. We talked about that because they're buying back shares. Long-term liabilities to 5-year free cash flow average, they want that under 5 if you divide long-term liabilities by the 5-year average free cash flow. And is at 0.82. That's what we talked about. So they can easily cover their debt. Cash flow growth over the last 5 years, 21 billion. So that gets a check mark from them. And then 5-year price free cash flow, they want it under 22.5 and it's 18.22. So that's all there. That's great. That means that it checks all the boxes to be what they would consider a strong 8-pillar stock. But what I love about this is the stock analyzer tool. So if you have assumptions, and this is where you got to do your own research, you got to look at analyst expectations, think about what's important to you as an investor. This is awesome for coming up with a range of prices that you might buy at. There's an art to this though. So we see that their 10-year revenue growth is 40.8%. Their 5-year revenue growth is 28%. Their 1-year revenue growth is 27%. Well, I don't think Facebook is going to grow revenue in the future anywhere near this 10-year average because it's law of large numbers. They're a much bigger company. They have a lot more revenue now. It's so much harder to grow it at that pace moving forward. It's pretty safe to assume, though, that they're going to keep a relatively consistent profit margin and free cash flow margin if it's been this consistent over time. We can see how consistent that's been over 10 years all the way up through the last year. So the other thing we can do is we can look at analyst expectations for revenue growth if we want to get a feel for what we should use for assumptions. There's a couple ways we can do this. We can look at something like Seeking Alpha. I think you can get this from Google as well. If you go to earnings and then earnings estimates, you can see that analysts are expecting all the way out through December 2031. But really, I mean, these are going to be wrong, right? So we take that with a grain of salt. But you also have to look at how many analysts have their estimates in. And so it's 3, 3, 3, and 2 for those last few years. So here's the 2027 is the last time they have 7 analysts. So they're expecting 6% growth this year, and then 15, 14, 12, 10, 6, 0, 6, and then 6, right? So what we can do is this is Ticker, another tool. I know we're all over the place, but what this does is it gives you the compound annual growth rate from 2022 to 2026, and the analysts are expecting it to grow around 12%. So I think that's a decent part to use for the range. If I want to be conservative, potential recession, let's go 8%, 11% for mid, and then high. I actually think that there's a chance with crypto imploding, NFTs imploding, all this talk and fear of decentralization and moving away from Web 2 to Web 3. Does that happen over time? Potentially. Is it going to disrupt these platforms in the next 10 years? I don't think so. And I think that what that means is that platforms are still going to be valuable, where people can have marketplaces and monetize things and have their businesses. What Facebook is doing in the metaverse, if anybody's going to win it, it's going to be a company that's as strong as Facebook. Mark Zuckerberg has gone out and bet the farm before on going from desktop to mobile. That was unpopular when it happened, and it paid off. They have a lot of data. He's smart. If anybody's going to get this right in the metaverse, it's somebody like Mark Zuckerberg and somebody with the resources like Meta, in my opinion. The sentiment is so negative right now. And if other advertisers get hurt in an economic downturn, somebody like Meta can benefit from that. Because more companies are going to have to advertise somewhere. And if Facebook, Instagram, these different properties they have are a place that they can still do it and do it cheap, they're probably going to do it there rather than somewhere else. And so if anything, Meta might come out of this whole thing stronger. So the high range, and this is a high range, but let's go 17%. We're going to keep profit margin for low. We'll go to 29. We'll go 30 and then 31 for high. Same thing with free cash flow, just to be conservative, 31. And then PE, I think that 12 is actually very low. 15 and 18, I think that's fair. It could even be, that could be conservative, but we'll see. So we'll go the same thing. Desired annual return, you can get an annual return of about 8 to 10% from investing in S&P 500 ETF. And so Paul from Everything Money, he does this as well. He uses 12.5 because he wants to take his hurdle rate is a little bit higher than what the average he could get from just investing in something like the S&P 500 is, because you want to be rewarded for just the headache of owning individual stocks and the extra volatility and the extra risk that you might be taking on. So he usually does 12.5%, but there's a lot of unknowns with Facebook. So I'm going to go 15 just to have a little bit higher desired return. This is crazy. And it makes me think that I'm just being not conservative enough with these numbers, and there's a chance that I'm not. But remember, this is the high end that I wanted to go to just to give myself an idea of like, hey, what is the potential upside? And if things really worked out and this high scenario works, which is not absurd, 17% revenue growth, and this is 10 years out, 31% profit margin, 31% free cash flow margin, PE of 18, and a price free cash flow of 18, then you would be willing to pay $438 a share right now. It's at 162, so that would be a screaming buy. But I think that's the extreme high end. I would orient more towards, especially in this environment, low to somewhere between low and mid. Even in this low scenario, 8% revenue growth, 29% profit margin under what they've had, 29% free cash flow margin under what they have, and a historically low price to earnings multiple of 12 with a hurdle rate of 15%, you're still looking at a low of 172, meaning if it's under that, that's when you want to be buying. It's at 162. So another thing I love about this tool is that you can add alerts to your watch list. And so if it goes, above or below a certain price, I've already got one in there and it's already below this price, so I don't need to set an alert for below. But maybe another way to use this is, so 246 is the mid, right? So maybe I want to make an alert for above. If I'm thinking about buying this stock, or if I own the stock, I might want to do an above price range. So if it goes above 246 and I own the stock, I want to take a look at it. And maybe it's a reminder to, hey, trim, sell, whatever. So I'll set that, and then I'll go to my watch list, and then it shows you. And again, not getting anything from these guys. I literally pay for their tool. I just think it's great for investors. And so here it is. Here's Meta on there, target price of 246. So let me know if you like this video, if this is helpful. And I will go through all the companies in my portfolio. And I'll also start incorporating this into videos that I use. I've used a lot of fast graphs because I pay for their tool. Use a lot of Seeking Alpha for estimates. I've used Ticker, I pay for that. And I will start using this and incorporating this if it's helpful to see those ranges. Not a recommendation. Don't recommend anybody just follow anyone else. But maybe go and do more research or add it to your watch list and start learning about the stock.